What is an IPO? An initial public offering, or IPO, is the term used for the first sale of shares sold by a company to the public. After an IPO, a company is referred to as a public company. Because shares sold to the public in an IPO are listed on a regulated stock exchange, public companies are also referred to as listed companies. The shares sold in an IPO can be new shares issued by the company for the purposes of the IPO, or they can be existing shares held by private stakeholders, or a combination of the two. Before an IPO, the company is usually described as private. When a company is private, non-connected private investors have a limited ability to purchase or trade shares, whereas public companies have sold at least a portion of their shares to the public. Hence, doing an IPO is often referred to as going public. The World Federation of Exchanges says there are 48,000 companies listed on its member exchanges. We are all familiar with large public companies, including the largest, like Google, now Alphabet, Microsoft, Amazon, Facebook. However, there are also some very large companies that are private, like Mars, Cargill, Aldi, IKEA, PwC, Deloitte. So while many large firms have IPO'd, many have not. So why do an IPO? Given the huge variety of different companies, sectors, and owners, there is no one answer to this, but a number of key factors. The first reason is that IPOs allow access to capital. Capital technically means an asset that can enhance one's power to perform economically useful work. An IPO is directly issuing equity capital through selling shares, but it also impacts other areas of a company's financial capital. Creating a public market for shares means you have a broader investor base to access for future equity. At the point of IPO, new shares are often sold, raising capital for growth and development. Having traded shares is also viewed positively as a currency to fund acquisitions. An IPO gives stakeholders in the private company access to public markets to potentially sell their shares and exit their position. Stakeholders in a private company can be family members, angel investors, venture capital, and private equity funds, or institutional investors. Some companies offer shares to the public because existing shareholders do not want to contribute more equity. This can be for a host of reasons, including reaching the limits of retained earnings and debt capacity. Access to greater potential liquidity and enhanced reporting requirements can be broadly positive for the overall cost of capital, potentially allowing for greater bank lending or bond market issuance and lower interest costs. There is also some analysis showing that not only does an IPO enhance the currency for takeovers, but that recent IPO candidates are more active as acquirers. In fact, a survey of CFOs said having listed shares as acquisition currency was the most important reason for doing an IPO. In absolute terms, an IPO is often the single largest capital raise that a company will do. Private companies clearly have many options to raise capital, borrowing from banks, issuing bonds, finding additional private equity investors. But largest single financing events are typically IPOs. So, for instance, Facebook raised $16 billion in 2012, NL $17 billion in 1999, and Alibaba $25 billion in 2014. The second reason is liquidity. Liquidity in the financial markets is a term used to express the degree to which a security can be quickly bought and sold in the market, and in what size. So the most obvious point is that an IPO creates a market for your shares. This helps existing holders to potentially sell shares or at least have a clearer valuation. Liquidity creates a real-time valuation, which is helpful for investors generally. And liquidity allows more investors to buy shares, increasing the size of the investor base and therefore the potential value of the company. Employee incentives. Employees in private companies, especially startups, are often partly remunerated with shares in the company. Having an IPO is a key step in allowing them to value or sell these shares. Also, many companies use employee stock options, or ESOPs, as part of their ongoing remuneration, broadly to many employees, but also as key incentives for senior management, often with performance criteria attached. Being able to offer these sorts of share options is seen as helpful in retaining staff, as some banks will provide loans against listed shares, Going public, even without selling shares, can give shareholders an ability to raise funds. For example, Jim Clark buying a yacht after the Netscape IPO. Improved profile and status. Going public raises a company's visibility. This not only means equity investors, but it can also help with other investors, like bond funds. The status of achieving a listing and the required disclosure can also be helpful with customers and suppliers. The enhanced financial reporting and transparency demanded by stock exchanges and regulators gives external stakeholders a greater level of insight into performance and corporate strategy. What is involved in doing an IPO? Prospectus. While stock exchanges have varying rules for allowing a company to list shares and go public, they typically require a listing document or prospectus at the time of the IPO, and also have ongoing reporting, disclosure, and transparency requirements. So, before starting the process, companies need to review the key requirements. For example, 3 years of profitability, fully compliant board structure, good corporate governance, and so on. And even start planning years before an IPO itself. The IPO prospectus is a lengthy document that goes through at least 3 years of financial information in great detail, with auditors and banks doing extensive due diligence and then disclosure. The prospectus is designed to provide the public with detailed information about the company, much of which is not required for a private company. The prospectus is in a standard form required by the stock exchange and is reviewed in detail, often requiring many iterations to fully meet the listing requirements. Ongoing reporting. There is also an ongoing requirement for periodic financial reporting, major shareholder disclosure, and other information for public investors. In addition to discussing timely financial information, often on a quarterly basis, there is ongoing reporting of senior executive remuneration and incentives, as well as strong internal processes and controls to continue to generate the required information on a timely basis. Additional regulations. Listing also brings in rules on how to raise new capital going forward, partly to protect the broader public investor base, as well as rules around takeovers, share buybacks, and disclosure of significant transactions. How is an IPO priced and executed? An IPO can be headline-grabbing news, and for many companies, the greatest amount of public attention and media profile it has ever achieved. So there is a lot of attention on the pricing range and implied valuation, actual pricing, and of course, the first day of trading. While there are different methods of accessing the market for the first time, the most common is done by hiring a syndicate of investment banks that markets the company's IPO using an indicative range to collect buy orders from investors. The collection process is commonly referred to as book building, where investors give orders, often with price limits, to the banking syndicate, which enables the syndicate to build a book of demand. At the same time, senior management of the company typically goes on a roadshow, seeing investors around the world if necessary, giving a series of meetings, sometimes one-on-one for the largest investors, or through larger breakfast or lunch meetings. At the end of this process, the company with its shareholders will review the book of demand with the lead banks and hopefully agree on the initial listing price. While it is uncommon for 100% of the shares to be sold, the London Stock Exchange's main index requires at least 25% of the company to be available after an IPO, for example. Companies and shareholders do not want existing shares, known as secondary shares, or new shares, known as primary shares, to be sold too cheaply. Yet, in 2018, IPOs globally traded up almost 15% on their first day on average, which is in line with long-term precedents. Why do IPOs trade up on average? One key reason is that IPOs are priced to compensate investors for the risk of putting orders in for a company that has never traded. And of course, IPOs do not always trade up. Facebook traded down 30% in the few weeks after its IPO. Other reasons include encouraging increased trading and therefore liquidity, and ensuring a wide base of owners. For example, by not excluding too many investors in the initial book build. It is also suggested, though, that banks will push for low pricing to favor their largest institutional investors. Google looked to use an alternative auction process rather than book building to try and mitigate this, which did lead to a successful IPO, although interestingly, it also traded up 18% on the first day. Why might a company not IPO? Disclosure. The flip side of being public is the ongoing commitment to full and regular disclosure, not just in the initial prospectus. As a share price is the most visible part of a company's financial profile, this regular disclosure can lead to short-term reactions, which some companies feel detracts from longer-term goals and targets. Ongoing costs. An IPO means additional ongoing accounting and marketing costs, as well as full-time staff in areas like investor relations. Time commitment. An IPO brings a huge time commitment from senior management in the due diligence and marketing of the IPO itself, as well as regular ongoing results and strategy updates for investors. Increasing time and attention required at the expense perhaps of time spent focusing on the business. Extensive information disclosure. Public dissemination of information provides substantial previously private information to competitors, suppliers, and customers. One need only look at the forensic analysis of every set of Apple results to see material moves in related suppliers or end users. Loss of control. New shareholders bring potential loss of control, mainly through the board of directors, which is required to have a majority of non-executives who are voted for at each AGM. So an IPO can be an attractive way of selling some shares for existing shareholders compared to selling part or all of the company to private equity or to another company, where loss of ownership and control is much more likely. However, an IPO does dilute equity ownership, and this reduces control and autonomy. Over time, if the business continues to grow and the original private shareholders are diluted, then the risk of takeover, with even less control over the potential buyers, is a long-term possibility. How big is the IPO market? In 2018, there were over 1,300 IPOs globally, raising proceeds of just over $200 billion. While the absolute number was down from 2017, proceeds were up 5%, with several larger tech unicorns listing. Regionally, Asia remained the largest with 48% of the value, with Americas at 29% and Europe at 23%, broadly in line with recent precedents. Although as recently as 2014, the Americas was and had been the largest IPO market. For sellers, while there is much historic discussion of both government privatizations and private equity owners, these two groups represented only 1% and 9% respectively by value. In fact, privatizations have been at this level for over 5 years. And by sector, it is perhaps not surprising that the technology sector had the most IPOs, followed by industrials and healthcare. These three sectors together represented half of all IPOs. In conclusion, for larger companies, going public through an IPO is a natural step. While the process itself is hugely time-consuming and expensive and brings serious ongoing time and disclosure requirements, the benefits of having access to a wider pool of capital, as well as a clearly valued and liquid share for employees, investors, and other stakeholders, outweighs the negatives.